So welcome everyone to BankTech Ventures and Stablecore's special briefing on stablecoins and the Genius Act. Just 10 short days ago, the US Senate passed the Genius Act, which would become the federal framework that allows both banks and qualified fintechs to issue stablecoins. It's anticipated that the major shift will be signed into law this summer and live as early as 2026. So I'm sure a lot of you are wondering, why should banks care? Alex will go into depth on this, but I just wanted to kick this off with stablecoins are already moving over 700 billion per month with explosive growth in B2B payments and Treasury. And these flows compete directly with your commercial deposits and fee income. So to help us unpack what this bill means for you and your institution, we're joined today by our exceptional panel. Alex Treece, CEO of Stablecoin, a stablecoin and digital asset sidecar for banks, previously at Coinbase. Alexandra Barrage, partner at Morrison, Foerster, and former FDIC exec, where she spent many years working on policy. And Matt West, CEO of Xenios and former chief strategy officer at MVB Bank. With that, I'll hand it over to Alex to kick us off.
Thanks, ma'am. And thanks everybody for joining us. So just before we get into it, I wanted to quickly hit our agenda. So I'm going to cover stablecoins, sort of do a 101, talk about current landscape, and then also use cases. Then I'm going to pass it over to Alexandra, who's going to talk about Genius Act and some of the key provisions there and just how you should be thinking about it from a bank perspective. Then we're going to pass it over to Matt, and he's going to talk about strategy and risk management and specifically go through some opportunities and risk. And then finally, we're going to do Q&A at the very end and take open questions from you guys, and hopefully lose some time to do that. But to kick things off, I'll start with a quick primer on just what stablecoins are and just help us level set there. And so stablecoins are privately issued money. They're a liability of an issuer, not of a bank. And they're pegged to and redeemable for a fixed amount of currency. So if we're talking about dollars, that means $1. And they're backed one-to-one by underlying high quality liquid collateral, things like repos, things like treasuries, things like deposits. So think, under 90 days, between 1 and 3 months duration. They cannot be lent out, so they're not deposits. And they also transact on blockchains, which is what gives them some of their special properties around 24/7 and instant. And so that's what stablecoins are. It's also helpful to cover what stablecoins are not, because they're often kind of confused with other types of assets. And so, as I mentioned earlier, they are not deposits, not from a legal standpoint, not from a regulatory standpoint, not really from any standpoint. They're also not FDIC insured. And you could actually argue that because they're one-to-one backed by this sort of high quality liquid collateral, that they don't need to be. And they're also not tokenized deposits, which is something that often gets confused, and we'll talk a little bit more about in the next slide. They're also not securities or commodities, which is something that the Genius Act makes very clear. And they're also not Bitcoin or meme coins or other cryptocurrencies. They are much more similar to other types of more traditional dollar-based assets. And then finally, they're not CBDCs. The difference between a CBDC is that would be something that's issued by like a government or by the Fed. These are, again, privately issued dollars, and they're also liabilities of a private issuer. And so that's what they are and what they're not. And I want to take just one moment here to linger on this distinction from tokenized deposits, because many of you may have seen things from JP Morgan. They recently came out with the tokenized deposit, JPMD. And so these two get confused, quite often. And so it's helpful, deposits and tokenized deposits are both deposits, right? So they're both liabilities of a bank. They both have deposit classification. They're both FDIC insured. And so when you see tokenized deposits, think deposits. What tokenized deposits share with stablecoins is that they both ride on blockchain rails. So they're both 24/7, they're both instant, they both are on this shared ledger. And so that's how you should sort of differentiate this world and sort of think about those. Great. So with that, we've kind of got a quick primer on what stablecoins are. We can talk a little bit about the current landscape, maybe starting with just how big it is. And I think people are generally surprised to find how big this market is today and just how quickly it's grown. So I put some stats on here just to help illustrate that. The first is around total supply or market cap, and that's grown from early 2020 of around under 5 billion to all the way up to 230 billion today. So just absolutely astronomical growth, around 57x in that time period. If we look at monthly active accounts, so these are the number of kind of accounts we can see on the blockchain that are doing activity, that's grown from under 1 million in that time period all the way to 50 million. So again, even stronger growth there. And then lastly, if we look at monthly stablecoin volume, we can see that that's grown from under 15 billion in early 2020 to around 750 billion today. So again, just absolutely enormous kind of market. It's grown very fast, if not the fastest growing payment rail, certainly one of the fastest. And just to give you guys a sense of kind of relative scale, I put a graph here that shows in 2024 the size of the kind of total transaction value versus Visa, MasterCard. And as you can see, the total aggregate kind of value of stablecoins has actually gotten to be bigger than Visa and MasterCard. So again, I think this is just another good example of just how big and how fast these things have grown in such a short time period. And so that's where the market is, but where is it going and how big might it get? Well, there's been some great research recently from Citi that they've put out that's basically examined this exact question. And they've estimated that between now, again, we're around 230 billion of supply today, and 2030, so roughly 5 years from now, they expect the market to grow between 1.6 in their base case to $3.7 trillion. So think 10 plus X potentially if we take around the midpoint of that. And I think a really interesting part of this analysis is that they're expecting a lot of that growth to come from non-crypto markets, which has been something that has driven a lot of the stablecoin volume in the past. And they're anticipating that other areas of the financial system will end up driving a lot of that growth in stablecoins. So obviously that has enormous implication for banks, that has enormous implications for just the financial system in general. And so really interesting to see some of that data and some of those predictions. So who are the key players that are actually driving a lot of this growth? You might be surprised to find that it's just really two big guys. So it's almost Visa and MasterCard-esque. And there's really two players. One is Circle, which is the kind of dominant US-based player, and the other is Tether, which is the dominant ex-US based player. And what's been interesting about this market is that there's been some really big companies, folks like PayPal, folks like Ripple, that have tried to launch other stablecoins. And what we've seen is that these two players really dominate, really any metric. If you look at volume, if you look at total supply, if you look at number of wallets, they all sort of come into this same bucket of these two players dominating kind of 90+% of the transaction volume. So you can see here on these graphs I've shared that you see a lot of green and a lot of blue. And that's because these two guys, again, are taking about 90+% of the share. So I think really one interesting thing going forward with Xenios and with bank participation in this space is to see, can banks kind of make a dent in this, and can other kind of participants through the Genius Act actually dent this duopoly, or is this going to continue to be a market structure where it's really just these two big guys sort of dominating? So that's something to definitely watch out for. So that's some of the landscape and some of the players. I did want to hit on some of the use cases. And of course, Matt is going to dive into this a little bit deeper later. And there's kind of many use cases for stablecoins, but there's three in particular I want to hit on. The first is around USD stored value and medium of exchange. And this is really where stablecoins started. And it was originally in the crypto markets where you had this asset class that grew from zero to trillions, and it was being traded all over the world. And those assets, of course, are going 24/7. And so they needed this dollar denominated asset that could basically keep up with these crypto transactions and be that medium of exchange. And so that's originally where stablecoins came from. That's where there's still a lot of activity today. And then another one in this bucket is around USD stored value. So as this market grew, there's effectively infinite demand for dollars over the world, and people started to realize, hey, wait a minute, I can actually hold these kind of digital dollars all over the world, whether it's in Argentina or Turkey, these other places where they have currency volatility. So you're seeing stablecoins being used as this kind of non-US bank account, effectively, all over the world that's sort of digitally native. And so that's one of the really big ones, both now and in the future. Another one I wanted to call out that's growing very quickly right now and is particularly relevant for banks is around B2B payments and treasury management. So as the infrastructure for stablecoins got built out, as the various network effects got built out all over the world, people and particularly corporates started to realize, hey, this is like a RTP FedNow that's global. I can use this to pay vendors, to pay contractors, to pay employees all over the world. It's cheap, it's fast, and it's this kind of new payment rail. And so what you're seeing now is just explosive growth in this particular area. And obviously that's very relevant to banking. And then lastly, the one I wanted to point out was around tokenized asset markets. As many of you know, there's folks that are putting traditional securities, repos, treasuries, loans, all types of things on blockchain specifically because they want to have this 24/7 and also shared ledger. And just like the crypto markets where you kind of had this need to be 24/7, there's also going to be a need for a medium of exchange that can transact with these tokenized assets. And it's very likely going to be stablecoins and potentially tokenized deposits. And so I would expect that, and this is a very fast growing area right now, and I would expect this to represent a huge source of a more domestic demand for stablecoins and also tokenized deposits. I did want to sort of double click into B2B because I did mention that was one of the fastest growing segments. There was a fascinating report that Artemis did recently that tried to look at, okay, if we sort of dig into stablecoin payments and we try to disaggregate the pieces there, so B2B, B2C, peer-to-peer, cards, etc., which parts of the market are actually growing the fastest. And what they found, and this chart on the right, is that the B2B payment segment was actually growing the fastest. You can see in the last 2 years, and this is just a subset of the data. That's why it's only 3 billion. It's only a handful of providers. But within those providers, within that data, they found that B2B payments was growing the fastest. And what's interesting is that lines up with some public things that we've heard from some big corporates. And there's two I want to share here. So one was from Robinhood, which announced on an earnings call recently that they're using stablecoins for weekend settlement. Obviously, Robinhood has a big crypto business, so potentially that's why they have that need. And then it also came out that SpaceX was using stablecoins to make payments to vendors, to contractors, and trying to hedge, some of their kind of currency kind of risk there. And so again, those are just two examples. There's many others, but I think interesting to see both the data and these sort of high-profile examples, line up or around B2B stablecoin payments. Okay, great. So it's a big market. There's some big players. It's growing very fast. There's some use cases for banks, but how do you actually get started and sort of how should you think about it from a technology perspective? I'm not going to do a super deep dive here, but I wanted to hit some of the big pieces that you probably should be thinking about. The first one is around custody and exchange. And so as many of you know, digital assets are different. They're on a blockchain. They're not on this legacy infrastructure. And so there's these specialized providers that basically handle this key management and do this blockchain-based custody. Think of them almost like a, sort of BNY or State Street, but for digital assets. And that's folks like Coinbase, Fireblocks, Anchorage, BitGo. There's many others you guys have probably heard of, but these are really important pieces in this ecosystem. And most of these providers also serve the dual function of doing the exchange. So they also, have the licensing so they can go from dollars to digital assets as well. So that's custody and exchange. And then another big piece is around compliance tools. So obviously this is a new type of asset class. It's a new type of payment rail, and there's new types of providers like Chainalysis, TRM, Elliptic that basically help you update your risk and compliance policies, and then from an operational standpoint, actually execute on that. And so that's obviously a very important piece. And since we're talking about stablecoins, there's of course the stablecoin issuers and the APIs. We touched on Circle a little bit earlier. They're the dominant US-based player. There's also Paxos, which is also an issuer that does both US and ex-US issuance. There's also companies like Bridge, which was recently acquired by Stripe for I think over $1 billion, which some of you may have seen in the press. And so, but all these providers effectively do a similar thing, which is they provide this sort of seamless convertibility between stablecoins and dollars and provide a lot of API infrastructure around that. And then last but not least is the ledgering and also integrations. And this is bringing all these other pieces, whether it's custody, stablecoin APIs, compliance, into your core and into your digital banking. And that's what my company, Stablecore, does as well, and sort of helps with that. And so that's going to be a wrap for me on the stablecoin side. And then I'm going to pass it over to Alexandra to talk a little bit about the Genius Act.
Thank you very much, Alex. Thanks everyone for participating. My name is Alex Barrage. I'm a partner at Morrison Foerster. I'm a bank regulatory lawyer with a very specific interest in digital assets, and many of my clients are both banks and technology companies and digital asset companies. Next slide, please. So I've looked at a lot of the Genius Act and also the Stable Act. I am actually a technical expert to both the Senate and House subcommittees who have been working on this in the case of the Senate. Just in terms of the posture of the Genius Act, the Senate passed the Genius bill on June 17th. The passage in the Senate was 68-30. So we got some additional Democrats to join in. In some respects, in large part, it is a bipartisan effort, although a lot of Democrats are still not in favor of this bill. Nevertheless, I think it has some significant momentum to get to the finish line. And at the moment, there's House staff looking at the current version of the Genius bill and looking at what may or may not need to be tweaked. We expect the final bill for the president's signature soon. It's not clear to me yet whether this bill will be coupled with a separate market structure bill, which candidly is a lot more complicated than stablecoins, if you can believe that. It may be that it's decoupled from that bill, or it may be packaged with it. We don't really know for sure yet. So who can issue? I think Alex touched on this a little bit. There's quite a range. And in fact, if you step back, really the point of this bill in many respects is to open up the entities that can actually issue payment stable coins. So in one bucket, you're going to have the traditional private issuers, Circle, Paxos, Ripple, also Tether, not a US-based company, as issuers. In addition to private issuers, we will see some insured bank subsidiaries, national trust banks regulated by the OCC, state entities, credit union subsidiaries, and foreign banks. We may also see, depending on how things go, the ability for non-financial services public companies, otherwise known as big techs. They might have a potential path here. There's a special committee set up for that, and candidly, the burden is pretty high. So while there may be a path, at least in statute, it's not clear to me, how that will be practically possible. Some of you may be familiar with Libra and Diem from years ago. There's a lot of concern in some halls of Congress about the payment, banking and commerce being mixed. And so we'll see how that develops. In terms of who regulates, one of the key features of the bill is the delicate balance it seeks to strike across having a dual framework, just like we have with banks. And so there is a state regulatory framework as well as a federal framework. Generally, issuers will have a choice. To the extent banks want to issue, the primary federal regulator will be the same primary federal regulator that they currently have. Private issuers that want to be regulated at the federal level will be chartered by the OCC and regulated, supervised by the OCC. To the extent we have this continuing duopoly, that's issuers over 10 billion, one of whom is Circle, they will be required generally to be regulated at the federal level. Next slide, please. So right now, we thought we'd be going over the bill at a super high level. We're not going to go through every technical provision. But at its core, you have to be permitted. You have to be licensed in order to issue, whether you're a bank or you're a private issuer. There's going to be a process that is yet to be fully described as part of implementing rules. We'll talk about that in a minute. But you can't just issue because the Genius Act gets signed. You have to actually go through a process. As part of that process, you have to apply a number of different requirements to the way that you do issuance, one of which is you have to maintain reserves that back those payment stablecoins on at least a one-to-one basis. So a simple example is if you're issuing one USD, effectively the digital equivalent of $1 US, you have to have high quality liquid assets, what Alex talked about earlier, that back that dollar in full, plus some kind of operational buffer that is yet to be defined. Your reserves have to be highly liquid. So the Genius Act talks about what those could look like. Those could be bank deposits, US Treasuries, certain types of repo. And this catch-all category, which is not defined, but basically would require federal banking agency approval. And next, you need to also do the monthly reporting that these private issuers do under current state law. Private issuers are generally regulated as money transmission, as money services businesses. They have to register with FinCEN, and usually the big ones mostly are regulated by NYDFS. And so a lot of the things that they currently do will have to be basically extrapolated for the other issuers. They're going to have to describe, what's outstanding, what's backing the amount of paid stablecoin outstanding. Their C-suite, members of their C-suite will have to attest. There are some pretty draconian consequences if there are misstatements. And there needs to be a process for timely redemption. And that refers to basically holders seeking to redeem their stablecoin for fiat. Next slide, please. So we put in some reminders here about some basics with payment stablecoins. One of which is, we get this question a lot, can payment stablecoin holders or issuers pay yield or interest? The answer unequivocally under the statute is no. Payment stablecoins are not deposits. They have, different characteristics from deposits. What kinds of activities can issuers engage in? Well, I've listed them here, but essentially think of this as a very narrow type of activity. You can issue, you have the obligation to redeem. If your holder wants that, the holder has a contractual right to redeem or seek the issuer to redeem their stablecoin. You can manage the reserves, you can custody the reserves, and there's a separate custodial list of requirements. And you can do the ancillary functions that support all the things that I just described. If an issuer fails, right, if there's some kind of insolvency event, The Genius Act also kind of walks through those protections. Essentially, at a very high level, what the language seeks to do is take those reserves backing the stablecoins and ensure that they're protected, ensure that they are not subject to third-party creditor claims of the issuer, and allow for a process where a bankruptcy court can determine what reserves are available for redemption and ensuring that those types of reserves get distributed on a pro rata basis across all holders. There's a little bit more to it, but that's essentially the basic function of this provision. Next slide, please. So here basically we want to walk through some key questions. First, what do the regulators have to do? Well, actually, they have to do quite a lot. Following signature of this Genius Act at some point, there is quite a bevy of rulemaking that needs to happen. It's approximately anywhere between 16 to 18 separate rules that will need to be proposed under notice and comment. So industry will have an opportunity to comment on those rules. And they need to be finalized, many of them within 1 year post enactment. So let's say hypothetically, the final Genius version gets signed by the president in August. That means the earliest we could probably have an effective date, and all the rules that we need to implement the act will likely not happen until first quarter of 2026. And that's really important. I'll get back to that on the last slide. The key rules that are going to be focus of the banking regulators and US Treasury early on are going to be BSA AML. That'll go out, I think, 30 days after the president signs the bill. And the second are capital, liquidity, and risk management. And the Genius Act actually has a blueprint for essentially what those kinds of rules should look like. And the bottom line there is they need to be tailored to the economic business model of the issuer. They can't make the business of issuing stablecoins uneconomic, right? That would undermine the entire purpose of the Genius Act. And they need to be carefully calibrated. So depending on whether you're a bank or you're a private issuer, there will be different rules that apply across all these different things. The state regulators for issuers that seek to be regulated at the state level will also have to do some implementing and state rules. Most of the rulemaking is going to happen at the federal level. But the most important thing, if you want to issue and be regulated by your state, is that the state needs to make sure its framework is substantially similar to the federal one. And that's because we don't want a situation where the federal framework has rules and the state framework has rules and they don't match, and we have regulatory arbitrage and we have two systems that don't work well together. There's a real desire to have a strongly homogeneous framework across both the federal and state regulations. We talked a little bit about what happens in insolvency and the fact that holders of those stablecoins will have first dibs and super priority over their reserves should the issuer fail. Next slide, please. So very quickly, I want to touch on what I think the goal ought to be in all this exercise, just kind of thinking many steps ahead. Nothing about stablecoins will work, in my opinion, if it's not a trusted payment instrument. And that's what I mean here when I say good digital cash. Just like money today, like it doesn't work unless there's trust behind it, right? And there have been hundreds of years behind private bank money and how we think about commercial money. Could we get there with something like stablecoins and digital cash? Well, we'll need to build frameworks and systems where the public has confidence that it's a medium of exchange that's fluid, that's efficient, that's trusted. Users have to have confidence that we have good frameworks and clear rules, not just in the US, but of course across the world. And most importantly, customers have to believe and trust that their stablecoins and the reserves backing them are going to be protected, including in the insolvency of the issuer. So a lot of those policies are what's driving so many of the provisions in the Genius Act. The next set of bullets just kind of walks through what we would need to do there. If we have legal frameworks that are thoughtful and are strongly similar, then I think we will have a world pretty soon where stablecoins come out of this kind of fringe DeFi environment, supporting lots of different types of economic use cases, including in payments, internal treasury, to Alex Treece's point earlier, we could see a much more robust issuer framework, moving from the current duopoly that we have to a system where we have many players. We will hopefully see greater interoperability across the different blockchains where stablecoins essentially live. If we have all those things, and if we have a proliferation of issuers, at the end of the day, it probably shouldn't matter whether you're holding USDC or you're holding Paxos USD or Ripple. If they're all required to be regulated the same or mostly the same, then these will just be like the way you use digital cash today. No one looks at the serial number on their dollar bill. People just trust it. And so if we do the things that we need to do from a regulatory perspective and a supervisory perspective, it's possible we could get there. And it will take time, of course. Next slide, please. So I think there are 3 underappreciated points that I take away from my study of these bills, and I want to share them with this group. The first is what I mentioned before. There's quite a lot of rulemaking that needs to happen, and within a relatively short amount of time. U.S. Treasury has, like, I would say, the bulk of this responsibility, along with the federal banking agencies, many times in consultation with the state level agencies. As I said, I expect this will be all for notice and comment. So for all the bankers listening on the phone, you all should really be thinking about how to engage as part of that process, which will start in earnest, following signature, just based on where the timelines are in Genius today. If we're not thinking about all these different rules and interlocking pieces strategically and early, there is some risk that we could be working against ourselves and not getting close to, the GDC and the good digital cash that I talked about before. So I think it's important for the agency to organize early and think through those pieces. If I were to rank my top 2 in terms of sequencing, again, I would focus on BSA AML, as well as looking at capital, liquidity, and risk management frameworks. For those banks that might be issuing, they'll have to have redemption policies and things that they've probably never thought too deeply about. But those are kind of second order things. Of course, broader risk is that if we don't have rules that line up, that we will have a race to the bottom, either in the United States, which I think there's less a risk of based on my reading of Genius, but globally. I won't go into that so much now because this is more of a domestic discussion, but just something to think about. Next slide, please. Lastly, I just wanted to share a little bit about what my team has already been doing with clients. The bottom line is banks are moving. They are not waiting for a signature on a bill. Many of the sophisticated banks that I'm working with are really thinking about nuts and bolts. If we wanted to issue in 2 months, what would that legal structure look like for us? How would we set up that legal entity structure? What are some different models? How do we think about those models? What are the tax consequences? Where would the reserves sit? Who manages those reserves? All those really important questions. Those are cutting edge questions for banks. That's why it's so exciting to really think about it with them. Clients are looking at these interim solutions prior to the effective date. The earliest would be, I think, Q1 of 2026. Now imagine we're going to already have some rules or many rules in place. Now I think the opportunity is to help drive what those rules will look like in concert with regulators. And that's kind of the fun piece that we get to work on now. Many banks don't realize that under current interpretive letters, both at the OCC and guidance coming from the FDIC, if you're a bank whose primary federal regulator is either of those agencies, and potentially we'll also hear from the Fed on this, you can engage in crypto asset activities under ordinary supervision so long as that activity is well risk managed. So you don't actually need Genius, in my view, to go out and do these things. So long as you're building thoughtfully in a risk managed way, giving your regulator transparency into what you're doing or what you want to do. Technically, that's the world we are in right now, following issuances just, I would say several months ago, starting in March. So I think this presents a really interesting opportunity for banks who want to keep learning and maybe building. You're going to need a very interdisciplinary group of experts, both internally and externally, to accomplish that. Internally, you're obviously going to want to bring in your risk and compliance team to the extent you have an R&D team, and obviously members of your bank boards and potentially other groups, other risk committees, audit committees, it really takes kind of a team effort, which is what I'm finding. In terms of the legal know-how, it really cuts across so many different areas in my firm: corporate, bankruptcy, payments, tax, IP. We're seeing banks wanting to white label stablecoins and working with partners on the outside and thinking through all the economics of that. And of course, thinking through, do they have the infrastructure to do that, to Alex Treece's point? And of course, do they have the risk management that they need to have that's specific to this kind of activity, which Matt West will touch on in a minute. Bottom line is, I think if you have a team of experts, both internally and externally, and you have good relations with your state and federal, counterparts, your regulators, you're well positioned to start thinking like this. And to the extent you just have questions about how to think about it, definitely reach out. We've all, I think, been on the receiving end of those kinds of questions from the industry. So I'm happy to answer questions at the end, and I'll turn it over to Matt West. Matt?
Yeah, thanks, Alex and Alexandra. Alex and Alexandra and I have had multiple conversations, and we presented there's a few times that we presented together, and I learned something each time. So I always appreciate working with them. So we'll jump into it, and I'd say so that the first thing to think about as I walk through the slides, where do you want to be, and where do you want your bank to be on the adoption curve as it relates to stablecoins? By definition, we can't all be innovator or early adopter. We can't have 100% of us being in the top 15%. So as we talk through these and some of the opportunities, I think it'll start to fall out which banks are most likely to be early, and a lot of that's based on the opportunities that are most immediate. And as we look at the next slide, Visa put out a white paper on stablecoins, just emphasizing what Alex had led with. The early days of stablecoins is really utility for crypto capital markets. So I think that's the first piece. If you're a bank that is currently supporting crypto or digital asset customers or digital asset exchanges or some of the custodians, then it's likely that you're already pretty far down the path of talking about a stablecoin strategy. If not, you probably should be. The other opportunities or opportunity categories that are, I'd say, current today: cross-border payments. It comes up quite frequently, whether that's B2B and or some remittance or payout. But cross-border is their active businesses in that today. Much of what Stripe and Bridge are doing are related to cross-border. Then a third category for that, and I'm going to pick up a few of the questions as we go in. Merchant acceptance or merchant processing. Payment acceptance is a third category that we're seeing active business being built and pilots and prototype working through. So someone asked about Fiserv and their announcement. They had a couple of different announcements last week related. One was with the issuance of their own stablecoin called FIUSD. And the other one was with MasterCard and talking about the acceptance for anyone who's working with them as a processor. So I think that's probably more defensive at this point, given what Stripe's doing. Also, you saw Coinbase and Shopify have a similar announcement around payment acceptance. So multiple opportunities. What I have to do over the next few slides is to give you a high-level framework to understand the opportunity as well as to assess the risk. So whenever a bank CEO or leader reaches out to me and says, hey, what do you think about stablecoins, or what do you think about this particular opportunity? I just try to qualify it first. The first 4 questions here are really about roles and responsibilities. The last 3 are more about value and value creation. So in any opportunity, there's a question of who's going to be the issuer of the stablecoin, who's using it, who's holding or moving the stablecoins around, and who's the bank's legal customer. Just something to emphasize here: there are stablecoin opportunities for banks beyond beyond or without the bank being required to be the issuer. So that's sort of one thing as we work through an example, is you don't necessarily have to be an issuer of stablecoin to support some of these stablecoin opportunities and participate in them. I'd say the The question that I typically even ask before trying to understand the roles and responsibilities is just ask why stablecoin. I caution don't get caught up in the hype. Really understand what value is being created, what's the likelihood of adoption. My personal belief, most stablecoin opportunities right now, the biggest risk is lack of adoption. As Alex mentioned, it's really driven right now as an issuer by two main issuer parties. So I think any bank who's considering adoption or any bank who's considering issuing a stablecoin, really think about what type of capabilities you have and how much value you'd be creating with this opportunity, and what's the reason that users would adopt the stablecoin that you're issuing. And of course, the last one, obviously, is how will we make money. I'll take this a little bit farther and do an example on the next slide. The idea of B2C payouts, and this one being cross-border. If you look, those questions I just mentioned along the left side, there's two categories that we're seeing today. One is where a bank is partnering with fintech. So think this is sponsorship. If you're already sponsoring payments, then this might be something to look at. If you don't currently sponsor payments today, then this is probably beyond your risk appetite. The column on the right is if the bank were being the issuer. That changes who your legal customer is, so it would change any resulting sort of BSA AML responsibilities. I would say it modifies them some. So just being aware of each of the roles and responsibilities and what the bank is playing and how that affects your risk assessment. Good, next slide. High-level framework, we'll start at the bottom of this. Think of it as a foundation. Most stablecoin opportunities that you evaluate are going to be a new or expanded product or service. So it would start with a product risk assessment. What are the strategic risks, the regulatory risks, the credit risks associated with this, whether it's as an issuer, we're talking about B2C payouts or cross-border, start there. Then there'll be a number of functional risk assessments, whether that's your InfoSec or BSA AML, consumer compliance, liquidity, capital, updating those risk assessments based on the product. And then as you're looking at any customers or third parties, you have standard customer and third-party risk assessments today. So making sure that whatever this new product or expanded product you're offering, that you've updated those risk assessments to go along with this new customer base. And on the last slide, I think it is, I'll highlight, there's quite a bit of text on this one, so I won't try to read all of it, but I think either through a recording or through a copy of these slides, you'll have it. So for a number of the use cases, if you are considering this is out the primary risks, and probably with each opportunity, I usually try to associate what is this use case most similar to in traditional banking. So if we think of receiving stablecoin, maybe as payment acceptance, that's more similar to merchant processing or ISO sponsorship. So if you're not in the merchant processing or ISO sponsorship business today, the best way to think first about what your risks are prior to introducing stablecoin as the payment rail, understanding those businesses. For B2B payments, especially cross-border, very similar risks at the foundation to other cross-border or correspondent banking, depending on the structure in which you're going to be supporting those B2B payments. And then the bottom two would come up. Stablecoin issuer by itself. Being an issuer, you may have other use cases or multiple use cases you can support. Being an issuer, you're really trying to build a network. So I think in that case, think of it as, all right, if we want to build a new payment rail or to build a network, what are our skills and what are the risks associated with it? And then the last one, just holding stablecoin reserves is still an opportunity. This tend to be higher cost deposits, have a relative amount of risk just in terms of their liquidity side. So thinking that as wholesale deposits, and you're also, if you're holding stablecoin reserves, then you're going to have a money service business in today's environment. They're Circle registered as a money service business as one of your customers. So you'd be banking a large MSB. So if you're considering that, I'd encourage you to have the base capabilities associated with that prior to entertaining that type of relationship. And with that, I think we still have a few minutes for questions.
Thanks. I will read out the questions to our panelists, and whomever is the subject matter expert, feel free to chime in. So First, from Anonymous, as a bank, could I become a liquidity provider to the market and other banks if I want to build and support it?
I'll take that. I was with a bank at one of the large custodians. It was on one of Alex's early slides. And at the end of it, we asked, or actually the bank CEO said, based on your relationships, your conversations, what's the biggest opportunity out there? And they actually brought up the piece of being a liquidity provider is one of those that seems to be no one, or I would say not enough capacity stepping in to fill that. So I do think there's opportunity. I would say strategically, yes. I think for Alexandra to weigh in, not aware of any sort of regulation that would stop you from doing that today. Of course, you want to manage that risk well, but if you have those capabilities, I do think there's opportunity there, and I don't believe there's anything that would preclude you from doing that.
You're on mute.
All right. Matt West is right. The Genius Act is silent on this liquidity provider point. It's not the first time I've heard the question either. I think it's a great question. We don't really have a framework currently set up for this, but I think we will. And I don't necessarily mean a regulatory framework. I mean just something a lot more like a new kind of infrastructure for how to provide liquidity across a much broader swath of entities that are asking the same question. So more to come. But yeah, it's a great thing. I don't know, Alex, if you have any thoughts, if you've heard that question too.
Yeah, I mean, I think the short answer is, I mean, I would just summarize as yes. It's something that banks can do for all the reasons that you guys mentioned. But I don't have any comments to add other than what you guys added.
Yeah.
Thank you. The next one is about the Fiserv announcement, but I'm going to see if you guys want to add anything. Fiserv announced earlier this week that they're creating their own stablecoin called FIUSD. What could that mean for Fiserv banks? And how are they doing that without the Genius Act being signed?
Yeah, so I can maybe take first crack at this one. So just sort of definitionally, what did they actually announce? It was just a press release, so not an actual product announcement. And so it was more about their intent to kind of work on something in the future. And I think they also mentioned they're only launching it for Finxact. I'm not sure how many folks are on the call or on Finxact, so I don't think it'd be supported in DNA or Premier, for example. At least that it wasn't mentioned in the press release. And then secondly, it's not clear whether they are actually launching their own stablecoin or they're working with Circle and Paxos, which are the two stablecoin issuers that they mentioned in the press release. So I suspect, and I don't know, but I suspect that what they'll really do is have some type of white labeled kind of option through Paxos or Circle that's within the Fiserv ecosystem. And it may not be like an actual separate stablecoin. And as Matt mentioned earlier, I mean, it's really, and as I mentioned earlier in the slides, I mean, it's really hard to be an issuer of a stablecoin. I mean, it's as we've seen, really massive companies like PayPal and really well established and kind of capitalized companies like Ripple have tried it and failed. And so you have to have a really strong distribution. And so I think that's why Fiserv opted to sort of try to partner with Circle and Paxos, but it's honestly really early days. It's kind of been war of the press releases, to be honest. With like JPMD, with Fiserv's announcements, where if you sort of read the sort of fine print, all of them say, hey, this is stuff that we want to work on in the future, and they haven't actually built anything yet. So it'll be exciting to see, in the future, kind of what happens, but there's nothing there yet.
Yeah, I mean,
I guess, sorry, go ahead, Alexandra.
I was going to say this kind of forward-leaning public relations strategy that we're seeing is not something I really have seen banks do. It seems more out of the tech company playbook. I think you're right to read it with that fine-tooth comb, Alex, Treece. And I think just from the bank regulatory side, if any bank wants to have a stablecoin use case or iterate here, it's going to be really important that they work through all of the different issues before they even go to their board or talk to the regulator. There's a real important risk management component that I would just be really prudent about as a bank.
Thanks. Next is, how do they keep unregulated and non-compliant issuers from being used within the US? Is there a way to block illegal activity?
So I can keep this off. The way Genius kind of addresses this point is it has a definition of what's called a foreign payment stablecoin issuer. And it has this other definition for US-based issuers that have to be permitted. And effectively, there's a 3-year runway within which an issuer would need to comply. If you're a foreign payment issuer, you technically are not required to sign up to all the different things in the US Genius Act final statute, whatever that will look like. But you need to show that you have the capability to block transactions. And so if you are a foreign payment stablecoin issuer, and let's say you have a comparable framework in your jurisdiction, whether that's MICA or wherever, none of that has yet been determined by Treasury. That's a separate process under the bill. But if you are coming from a comparable framework, you have to show the technical capabilities so that if you get an order from the Justice Department or FinCEN because there's been some kind of illicit finance activity, you have to have the ability to basically stop that transaction. And issuers have that ability today. So there's a little bit of a different regime that applies to foreign payment stablecoin issuers. But the other point too is that exchanges or DASPs, digital asset service providers, would be prohibited after a time period of, I think it's 3 years, from listing non-compliant foreign payment stablecoins on their exchange. So there's another way to get at that compliance point as well. Matt or Alex, you guys want to add to that?
I think definitely agree with all of that. And then there are sort of more detailed pieces if one of these illegal are trying to, oftentimes they're going to need on and off ramps, meaning fiat on and off ramps. So in that case, they would need a relationship with the US bank. So if the banks are doing their job and their diligence, they would recognize that entity is not properly licensed, so they wouldn't be able to get banking for those. That'd be another way. Also, if they want to hold US dollars as reserves, same thing. Any bank in the US should recognize that they're not properly licensed, so they should get caught that way and be unable to hold any dollars in deposits at US banks.
Next, we have, what do you see as the single biggest opportunity for traditional FIs with stablecoins? Is it more offensive or defensive in nature?
You may kick us off, Matt. I'm sure you have thoughts as well. And so I think there's, so first, I think it's both offensive and defensive. I also think there's kind of a, crawl, walk, run paradigm as well. Like, you don't have to become Coinbase, in the next 6 months. And I think, and where I expect most people on the call is at the crawl phase, so I'll focus there. And I think we showed a bunch of figures earlier about just how big this market is, how fast it's growing. And I think if you think about like how the bank is positioned in their customers' lives, whether it's retail, whether it's kind of a business, it's as that kind of center of that financial activity. And so I think banks should want to retain to kind of be that center. And to the extent that this activity is happening outside the bank, you want to bring those capabilities into the bank itself, right? So the sort of crawl version, I think, is just bringing basic interoperability at the bank. So being able to deposit stablecoins, from this external world into deposits at the bank, and be able to send stablecoins as a payment rail from deposits, from the bank, right? Be able to offer as payment rails. And in that world, which I don't think is that complicated, it's not like you're becoming an issuer. It's not like you're becoming a cryptocurrency exchange. You're just continuing to be the trusted center of that customer's financial life, right? You're adding another payment rail, just like ACH, Wire, RTP, or FedNow that happens to be useful and happens to be something that they want. So that's definitely where I would start. And I think once you have the primitive of, hey, I can go between dollars and stablecoins at the bank, and I have that sort of capability, then you can sort of go down the list of your products, right? You can, whether it's private wealth, whether it's payments, whether it's treasury management, whether it's merchant payouts. There's many kind of opportunities in areas where the sort of stablecoin primitive could be useful once it's embedded. So that'd be my quick thoughts. I don't know, Matt or Alexandra, if you have anything to add.
If this weren't recorded, I'd be more comfortable answering, because I think a year from now, my answer will definitely be different. I don't know what it'll be, but I'm sure it will be different. So the most activity that I see today is around cross-border. So I think the large banks, the JPM, BNY Mellon, I think even put something out around cross-border. They have the most to lose as it relates to cross-border. So I think theirs is more defensive currently. For community and regional banks, I think there's if there's a bank that currently has capabilities, risk management capabilities in sponsoring cross-border payments, been working with a number of the payments companies who want to really leverage a new rail or a new infrastructure outside of the US, and I think that's opportunity. Those would probably be where I see the most activity today. And then I guess third one, any banks that are supporting crypto or willing to support digital asset exchanges. As I mentioned, the bulk of the activity with stablecoins is still around crypto capital markets. So that's the biggest piece of the pie. So finding, I think there are a couple of different ways to participate in that. That requires a bank to have the risk appetite to support digital asset or crypto companies.
Yeah,
And
I would
then
add,
stablecoin
I would add to
opportunity
that.
within. Sorry, go ahead.
Sorry, Matt, I didn't mean to cut you off. I was just going to add to what Matt said. A slightly different way of approaching this question is to say, like, at your bank, what do your customers care about? What kinds of activities do they engage in? What percentage of your customers hold digital wallets today? How many of them are engaging with crypto? Like, these are really basic questions. Like, we talk about these use cases because they're out there and we get questions on them. But I think, like, each individual bank has to understand for itself what does the core deposit base want in terms of its products? How do I keep that core deposit base? Are many of them engaging in cross-border payments to Matt West? Okay, how are they doing that? What's it costing them? You know, there are studies out there that say, you know, it's like 6 cents of every dollar just goes to fees. If you offered a stablecoin product, would it be less than 6 cents? What would it be? Like, these are all very basic, you know, questions that I think are worth exploring. And I think, you know, at the same time, the most sophisticated banks, to Alex Treece's point, are acting defensively. They are leaning heavily on tokenized deposits as an alternative in their view. Maybe not so, maybe they don't state it so obviously, but they're wanting to compete, and they will. And so I think it's not clear how this is all going to shake out. I think that, you know, smaller banks in many ways can be more nimble and potentially have an advantage, including acting in concert together if that's what makes the most sense as part of a network. We've seen stories about consortiums being formed, you know, so it's still really early days. But I don't know, Alex or Matt, market research on this, getting customer feedback. What are your thoughts on banks just like finding out more from their base?
Well, I'm not associated with Revio. I mean, I know BankTech has another portfolio company called Revio that sort of looks at, there's companies out there that sort of help you analyze some of your existing data. And so if you're not, you know, actively talking to your customers, which you should be, but there's ways to kind of analyze, you know, transaction history. I know that we have talked to banks that have seen, you know, and this is not stablecoins, but just sort of digital assets more broadly, you know, millions or tens of millions of deposits flowing out to places like Coinbase, these crypto exchanges, right? And that was kind of the sort of, you know, ringing alarm bells in their head, like, wait a minute, you know, these are deposits that are not coming back. And so anyways, that's not necessarily stablecoin related, but just more broadly, this idea of trying to look at the data and see what your customers are doing. And I think that's more on the defensive. And as Matt mentioned, I think like there's also offensive things you can do if you want to play in sort of a new vertical or serve this market. I mean, we showed earlier, this is a market that's going to go from 230 billion or so of supply potentially to kind of multi-trillions in the supply side. And then in the transaction volumes, we're talking tens and tens of trillions potentially. And so, you know, even if, you know, you don't have an interest in stablecoins may have an interest in you, and these assets may try to find a way back to your bank. And I think it's going to be just sort of table stakes for banks to at least support the rail.
I know we're coming up on the hour here. I just want to say we have quite a few questions left, but Alex and I will stay on as long as we need to get through all of them. I'm going to jump around a little bit though. So next is from Cassie. How will the Clarity Act and the Genius Act intersect?
So there are different acts. You know, Genius is specifically stablecoin specific. Clarity is really more about, well, just market structure, role of SEC versus CFTC, on digital asset securities, digital asset commodities, and those are all defined terms. Procedurally, how will they work? There could be one of two worlds. One is Genius moves through the House, there's a reconciled bill, and it gets separated from the Clarity Act. There's another world where they get bootstrapped together And so even if Genius is ready to go, it's going to be waiting in the wings until clarity gets passed. I don't yet know how that's going to play out, but I think they're equally possible. And I will say Clarity Act is a lot more complicated than stablecoins, and stablecoins, frankly, has had a lot of thorny, interesting issues itself. So that's about all I can say there.
All right. With North Korea having stolen over $1 billion in crypto assets in the last 2 years, how safe are stablecoins?
This comes up with sort of crypto in general, and we have to distinguish the safety of the asset and the protocols and these service providers that offer them, like exchanges. So if you look at most of what North Korea has done, it's mainly been hacking kind of overseas venues, exchanges and other types of things that have really shoddy security and probably really bad software. So that's not necessarily indicative that stablecoins and digital assets aren't safe. In fact, they're very safe. It's indicative that there's there's sort of parties out there that don't take security seriously enough, and they become targets. Right.
If my clients are exchanging in other crypto assets, should they use stablecoins to bring those back into the bank?
Well,
You want to go first? Yeah, I have a thought, but go ahead.
yeah, no, Matt, go ahead, kick it off, and I'll respond after.
Yeah, and I think if the bank's current customers are currently trading or exchanging stable coins that or other digital assets, they're probably working with an exchange unless they're doing really large and maybe working with over the counter and doing some things direct. So in that case, I mean, the most the way to is typically come back to the bank if the customer sells or exchanges that for fiat, and then the fiat could come back into the bank. I think there are different ways this question could go. If the bank were trying to figure out how to, so there is a path where the customer, they get out of a position in, say, Bitcoin, and they may choose to hold that in stablecoin as opposed to holding it in dollars or in fiat. In that case, if the bank did have the ability to receive and hold stablecoins, then potentially the customer could hold those stablecoins at the bank rather than holding those stablecoins on an exchange. So different ways I could interpret the question, but hopefully I gave you some direction of an answer there.
Well, just one thing I want to highlight, just taking a step back, is that if we look at the sort of tectonic shifts that have happened this year on the regulatory banking side, right? So OCC, FDIC, FRB, all kind of rescinding prior guidance and updating new guidance. It's not just stablecoins; it's also kind of digital asset activity, more broadly. If we look at the president's executive order on digital assets, it's not just stablecoins; it's digital assets more broadly. And so I would, and I know this is a call and this is a webinar about stablecoins, but I would encourage everyone to sort of take a step back and see that there's a much bigger sort of secular trend platform shift happening here around tokenized assets, digital assets, and just blockchain technology more generally. And stablecoins is kind of at the vanguard of that, and obviously like the Genius Act is bringing a lot of attention to that. But certainly, many bank customers are holding these other types of assets, things like Bitcoin. And I know we're working with kind of many other banks who are trying to develop the capabilities. And so you should think about developing the capabilities, the sort of technical capabilities at least, around stablecoins as being very similar to support other types of digital assets. And that's because we're really kind of shifting. It's almost like, every once in a while, there's these technology shifts that happen, right? Maybe like branches to online and then online to mobile. Well, this is yet again another one of these technology shifts, right? Where we're going towards sort of non-digital to sort of fully digital. And so as a bank, it is permissible for you to offer things like crypto accounts at the bank and do things like stablecoin payments. So if that's something you're thinking about, and again, we're sort of scoped to stablecoins here, but that certainly is now kind of in the same realm, and it's sort of permissible based on the regulators.
Yeah, I guess I mean 3 years ago there were multiple companies, fewer than 10, but multiple companies working on ways to where you could embed within your online banking a way for your bank customers to see and or have their crypto assets. So it could be they're just seeing them within your online banking, and some were actually working to where they could be held and custodied by a vendor and then displayed in your online banking. And I've started to see some of those pop up just within this week. I've been reviewing one for one of the banks I work with, reviewing an opportunity for a vendor / partner who sells to FIs and enables the bank's customers to be able to buy, sell, and hold digital assets. So I think those are coming back.
How realistic is the 2-year timeline to get the rules in place at the federal level?
Alexandra would have been much better to answer that than I am, but I do think I remember in some of our prep calls, she described it as a lot of work to be done in a short time frame, but I don't know that I have a good opinion to offer on how realistic that is.
Alex, any thoughts?
No, I mean, same. I mean, Alexandra is literally one of the world experts in that question, so she would be good to answer it. But yeah, so it's hard to say. I do think what I would point to is that there's a very strong sense of urgency from both lawmakers and from companies, right, to get this done. And so if you just look at the incentive structure, everything points to it's better to have it happen faster. So based on that incentive structure, I would expect things to move pretty swiftly.
Okay, I will send that question directly to Alexandra and include her answer in my post-event email. How may Genius impact foreign-based stablecoins?
I think Alex, that's another good one for Alexandra. She hit on it a little bit earlier. They have a carve out in Genius for kind of foreign stablecoins, and so it's mostly a technical matter. I think Alexandra would be a good one for that. And Matt, unless Matt, you have something to add.
Just a little bit more. I think so. Tether is the obvious one. They're large, one of the two large players, and they are foreign based. Most recent conversation, yes, there's a technical path, but I think they're working on a way of how Tether would fit within the Genius Act for implementation. So not clear, but for everything we hear, there's a path, or will be a path for them to fit within the Genius Act, or the implementation of the Genius Act.
Yeah, and maybe I'll just speculate here. I mean, I think given how big Tether is and how important they are, they're one of the literally one of the largest buyers of treasuries in the entire world. And I think they will. My guess is they will take a crack at trying to stay relevant in the U.S. They may. It's been kind of rumored that they may create a separate structure, so it'd have sort of this kind of U.S. based entity and sort of have Tether as the ex-U.S. But they certainly have the resources to try that. And so if there's anyone that is able to do that from a foreign perspective, it would be them.
Last question. We've been talking about this a lot at my institution. What would my tech stack need to look like if I wanted to launch this at my bank?
Yeah, I can lead this one off, and then Matt, feel free to share. So it really depends on what you want to do. But if we're talking about this sort of crawl version of, hey, I just want to bring basic stablecoin kind of interoperability at the bank, that's effectively working with an issuer or some type of provider like Circle or Paxos, and then getting that integrated into your core, getting that integrated into your digital banking. Of course, that's what my company Stablecore helps with, is kind of doing that to build that yourself. But if you kind of did want to build it yourself, that would be a path. But it's effectively, you can think of it as a kind of three pieces. On one side is the sort of crypto infrastructure. That's things like the custodians, Coinbase, Fireblocks, Anchorage. That's the stablecoin issuers like Circle and Paxos. That's the compliance tools like Chainalysis and TRM that I mentioned. So that's kind of like one side that you'll need. The other side, obviously, is the sort of existing tech stack of the bank, right? So the core and also the digital banking. And then in between, doing the ledgering and orchestration to help you do that movement of funds, for example, right? So if you're like sending a stablecoin from a deposit, kind of orchestrating with your core, orchestrating with a pre-funded account at one of the providers. And so those are all kind of the pieces that you would need. And certainly that's something that we help with. We sort of build that as a digital asset side core. But if you didn't want to do that, you could also basically kind of make those integrations yourself and then try to build all that piping yourself. But those would be the kind of key pieces you need.
Matt, anything you want to add on that?
Nope, I covered it well. I saw that question come through and I thought there's a softball for Alex. So.
Awesome. Well, that was the last question. And I know we're quite a bit over time, but if you guys have any other questions, feel free to reach out to me directly and I can share them with our panelists. And I will have this recording out to you guys sometime early next week. So thank you all for attending, and thank you for our great panelists for bearing with us.
Thanks, man. Thanks everybody for joining.